in this argument as to is it gold going up or the dollar going down or whatever, you've actually got a combination of things here. Because everybody is so underweight in real money, the mainstream sort of foreign holders of currencies thinking, well, where do I go with this overexposure to a currency? Do I go into another currency? The answer is probably not. The answer is probably you look at gold. And it's that correction. So I think the gold currency relationship could actually switch very, very sharply this year.
Throughout history, gold, which is legal money, has maintained its value in general terms with only modest variation. Fiat currencies have lost purchasing power since 1970. The dollar has lost over 98% of it. The comparison between gold and the dollar is simply between legal money and fiat credit, the only way in which relative values can be determined between them. The recent trend of gold maintaining prices above $2,000 might indicate a new normal for the precious metal. With gold's price remaining above this level for the longest stretch in its trading history, it raises the question of whether we are entering a period where higher gold prices become a standard expectation. Renowned financial analyst Alasdair Macleod underscores that the economy relies entirely on credit, lacking a firm link to gold. He foresees mainstream investors turning to gold for safety, possibly triggering a notable correction in the gold market. Gold edged higher on Thursday as Treasury yields fell after US GDP data highlighted that the pace of inflation slowed, while the focus shifted to inflation data for further hints on the Federal Reserve's interest rate cut strategy. Pointing out a growing inclination of central banks towards gold instead of dollars, Alasdair underscores the limited allocation of gold in global portfolios. There's no sign that central bank gold buying will abate in the coming year. According to the 2023 Central Bank Gold Reserve Survey released by the World Gold Council last spring, 24% of central banks indicated that they plan to add more gold to their reserves in the next 12 months. 71% of central banks surveyed believe the overall level of global reserves would increase in the next 12 months. That was a 10-point increase over 2022. Furthermore, Macleod contends that a mere 1% shift towards gold would demand a significant 23,300 tons, given the annual gold production of only 3,000 tons. Now, we present the clips of Alasdair Macleod's insights from his recent interview with As Good as Gold. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Getting back to the situation on gold, the general public feels no need to hold gold. I mean, they don't understand it anyway. They don't understand the difference between legal money, which is gold, and credit, which is actually everything is credit in our economy, and it is not anchored to gold. I think that I'd make two comments which people who are sort of complacent over this should hoist on board. And that is that central banks around the world already recognize this risk. That is why they're dumping dollars in return for gold bullion. They can't get enough of it, incidentally. I mean, I'm sure that if mine and scrap supplies were even larger, they would absorb that as well. If you look at People's Bank in China, they've been accumulating gold. Now, everybody says, oh, well, they're topping up their gold. I mean, there's a load of rubbish because it's so much gold off balance sheet that the amount they're taking is actually pretty immaterial. But when you look at it in the context of them winding down their dollar position, obviously what they're doing is they're liquidating dollars for gold. And this is just on the margin. Mm-hmm. And I suspect that we're going to see more pressure like that. And I think in 2024, we're going to begin to understand a little bit more why the central banks are doing this. Now, the second point I would make is that everybody is so underexposed to gold. There's roughly $150 trillion equivalent of portfolio investment around the world. That's bonds and equities and whatever. Now, the situation hasn't been helped. We're talking about regulated investments, but of course, gold is not a regulated investment. So that a portfolio manager doesn't actually regard gold as something he should have in his portfolio, because his compliance officer turns around and says, what are you doing? This is not a regulated investment. What it means is that from the days when I was a stockbroker in the 70s, when it was standard practice to have a portfolio exposure to gold mines and and associated investments of anything between 10% and perhaps 15%. We're now in a situation where of that $150 trillion, less than 1% is in gold. If they shifted just 1% towards where the historical hedge against a credit crisis would be, just 1% is 23,300 tons at current prices. In this argument as to is it gold going up or the dollar going down or whatever, you've actually got a combination of things here. Because everybody is so underweight in real money, when the ojo hits the fan, you can see that the effect, if you like, and running for cover into physical gold. And now whether it's people suddenly waking up, it's more likely actually to be the mainstream, sort of foreign holders of currencies thinking, well, where do I go with this overexposure to a currency? Do I go into another currency? The answer is probably not. The answer is probably you look at gold. And it's that correction. So I think the gold currency relationship could actually switch very, very sharply this year.
During the interview, Alasdair Macleod contended that gold is money, attributing property value increases to credit debasement and significant loss in purchasing power currency. In 2024, this perception of gold as a safe investment option remains strong as investors seek ways to protect their net worth against inflation and other financial risks. He distinguished physical gold as legal money and a safe haven from credit, while viewing gold-related investments like mines and ETFs as speculative. Throughout history, the price of gold would be far above its pre-war value when wartime spending and inflation ended. To restore the metallic standard to the pre-war price of gold in paper money, prices quoted in paper money had to fall. The alternative was to accept the increased price of gold in paper money by devaluing the currency. Let's get back to the interview.
I think the first thing I'd like to correct, Daryl, is that gold should not be viewed as an investment.
No, it's money.
It is money. Really, the rises in values and sort of property and so on and so forth that you've described are the consequence of the debasement of credit. It's the loss of purchasing power of credit. I mean, if you go from 1971, when the Bretton Woods was suspended, I mean, basically the US dollar has lost 98% of its value measured in real money. Sterling has lost 99% almost, and so on. And the same for the euro and, the currencies that made up the euro preceding, before the year 2000. I think the first thing I would say is that you're comparing, two different things, if you like, which are not the same. Gold is not an investment. A gold mine is, an ETF is.
Yeah.
A physical ETF, because you don't actually have possession of it. What you're doing is you're buying something which you think will rise accounting units of your portfolio. So physical gold, bullion and coin is legal money. And it is a refuge, if you like, from credit. Credit whose value depends on a combination of the rate of expansion of that credit at the central bank level, and also the faith in it. If the users of a currency lose faith in it completely, then it is totally valueless, irrespective of the quantity, the change in quantity in circulation. Inherently, what you're doing is you're moving from an unstable situation into stability. And the point about gold as money is that there is absolutely no counterparty risk in it. Whereas everything else, as we've been talking earlier, it's all, what we're looking at is counterparty risk escalating. Now, whether it's banks going bust, whether it's governments in a debt trap, whether it's the economy plunging into recession or slump, us anticipating that governments will, lose revenue, have greater welfare commitments, and at the same time will probably print credit in order to rescue failing businesses which employ lots of people. You've got the banking system that will have to be prevented from collapse. You've got all these big issues. You've got imbalances, like the ownership of dollars is just by foreigners is just beyond imagining. And if you get a bear market in equities, there's 14 trillion of foreign investment in the US stock market, in the US equity market. So what happens to that? No, a lot of it's just going to disappear with losses in the bear market. But as a foreigner, do you sit there in a foreign market holding your shares, which in a market which you got nothing to do with, but you were in there because you thought you would make money? what do? Well, you cut and run, don't you? And do you just cut and run and just add to your dollar bank balance? No, you probably sell your dollars as well. So you can see that the whole combination of things in the credit markets, which irrespective of these sort of synthetic gains on which you're taxed, by the way, this is a you can't make that comparison at all. We're looking at something far more serious. We're now looking at a credit system which shows all the signs of getting into the sort of systemic difficulties which it's almost impossible to imagine how it would be saved.
Over the past century, the dollar has lost 99% of its purchasing power. This means it costs 100 times more for the things you buy today than it would absent the effects of inflation. The enduring strength of gold as a store of value raises questions about its future role in shaping financial strategies. Do you plan to incorporate gold into your investment strategy, considering its perceived role as a safe haven? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.